Okay, dear students, let's start ACCA pre-scene mock December 2025. Okay, let's start. Question one. In question one, they're just asking you to calculate cash operating cycle. How do we calculate cash operating cycle? We need inventory days plus receivable days and minus trade payable days. Revenue 10% are cash sale, it means 90% is your credit sales. Cost of sale is 2,700 million, but 80% are purchases. Okay. Inventories, we have got 350 million. Receivable 420 million. Payables 250 million. Assume 360 days a year. Student, this is also very important. In exam, you have to check if examiner gives you something regarding how many days should I assume. If nothing is mentioned, obviously we'll go for 365. But if your examiner categorically says like here, then obviously we'll go for, then we'll be using 360 days. Okay, so it means in exam you have to check if days like that they are mentioned. So let's calculate inventory days. Inventory holding period. How do we calculate? It's very simple. Inventories, we'll take closing inventories, which is 350, divide by cost of sale, which is 2,700, multiply by 360. And you have to work for the closest days. 350 divided by 2,700 multiply by 360. Student, I'm getting 46.67. Make it 47 days. Receivable days. Simply, receivable days, it shows your collection period. How do we calculate receivable days, debtor days? Simply trade receivable divided by credit sales into 360. Why we are taking 360 days here? Because it is mentioned in the question. Otherwise, we go for 365. Receivables, trade receivable is 420. I will divide this with a credit sale. Total sale is 3,800 million. 10% are cash sales. It means credit sale is 90%. 3,800, I'll take 90% of it into 360. Let's see what are we getting. In the denominator, I am having 3420. 420 divided by 3420 into 360. Students, I am getting 2. So make one question to work on nearest days. Now payable. Payable period means when do we make payment to the suppliers? How do we calculate payable period? Simply we'll take trade payable divided by purchases, credit purchases. Obviously, nothing is mentioned, then all the purchases are on credit. Payable is 250. Cost of sale is 20. If purchases are not given, then we work on cost of sale while calculating payable period. But here purchases are given to us. And the purchases are 80% of cost of sale. 2,700, if I take 80% of 2,700, I'm getting 2,160. So 250 divided by 2,160 multiply by 360, it gives me 41.67 days. So let's take it 42. So inventory days plus receivable days minus payable days. You will get cash operating cycle. Another name is working capital cycle. So 47 plus 44 minus 42. I'm getting 49 days. So the answer is 49 days. Question 1. Let's go to the second question. Okay. Which of the following is our weaknesses in using financial statement to value what? Unlisted business. Let's read it again. Which of the following is slash R weaknesses in using financial statement to value what? Unlisted business, the company which is not listed at a stock exchange. So let's see what are the weaknesses. Financial statements are governed by the financial regulation. It is not a weakness at all. This is not the weakness. We are here to find out the weaknesses. Financial statements do not represent the future performance. That makes sense. Actually, it is not only with unlisted company, it is with the listed companies as well. Because your financial statement, they actually show the historic results, not the future performance. So it is even applies on listed companies as well, but we have other ways to find out the value of the listed company. So basically your financial statements, they represent historic information rather than the future performance. Financial statements are produced on an annual basis. Yes, they're not prepared on timely basis. So basically 2 and 3, these are the weaknesses. So option D. Assuming excuse me, assuming interest rate is 4.3% in 3 months time, what will be the financial settlement under FRA, forward rate agreement? Students, first you need to understand the question what exactly examiner is asking you to do. Assuming interest rate is 4.3% in 3 months time, what will be the financial settlement under FRA? Examiner is just asking you to calculate the amount which either you will have to pay or receive due to FRA. Repeat. Examiner is not asking us to show all the outcomes of FRA, show us the actual interest. No. Examiner is asking us only one thing. What exactly we will be either paying due to FRA or receiving due to FRA. We know that forward rate agreement is an OTC product. OTC product means which is available from banks. It is available from bank. Under FRA, interest rate becomes fixed for you. Another thing, normally examiner will give you two rates under FRA. In case of borrowing, you will get a higher rate. In case of deposit, you will get a lower rate. Now let's read the question. Stone company is expecting to deposit. The scenario is of lending. Deposit 25 million in 3 months time. We are not going to deposit. Stone company is not depositing after 1 month, 2 months. They will be depositing after 3 months. The deposit will be for a 4 months period. So company will deposit after 3 months for 4 months. So logically your FRA will be 3 versus 7. The difference between shows your deposit period, or in case of borrowing, it shows your borrowing period. So company will be depositing after 3 months for 4 months. So your FRA will be 3 versus 7. The interpretation of 3 versus 7 is the FRA will start in 3 months time, will end in 7 months time. So after you enter into FRA, it will work only for 4 months. So the relevant FRA for us is 3 versus 7. Stone is concerned that interest rate could fall. That makes sense because we are the lender, depositor. Depositor, lender, they face the risk of fall in the interest rate over the next 3 months. So it wants to fix the rate of interest now with a forward rate agreement. FRA has obtained the following quotes. 3 versus 4 altogether irrelevant. This is not a relevant FRA for me at all. 3 versus 4 means I'll be depositing after 3 months only for a month. The interpretation of 3 versus 4 is that company will deposit after 3 months only for 1 month. But the question says Stone company will deposit after 3 months for how many months? 4 months. So the relevant FRA is 3 versus 7. we are dealing with the deposit scenario. In case of deposit, you will get a lower interest rate. So the 4.7 is the fixed rate which belongs to you. It means that now interest rate cannot be higher than 4.7 for you. It cannot be even lower than 4.7. In any case, you will be getting 4.7. Okay. Assuming the interest rate is 4.3 in 3 months' time, what will be the financial settlement? Now, listen, student. We have fixed our FRA at 4.7%. Actual rate is 4.3. First, we will get the interest on the basis of actual rate, which is 4.3%. Then we'll be getting additional 0.4%. Why the stone company will get additional 0.4%? Because due to FRA, deposit rate 4.7% has become fixed for a stone company. So logically, first stone company will get 4.3% on the basis of actual interest rate, and then due to FRA, they will be getting additional 0.4%. And we need to find out the value of this additional 0.4 million. Deposit amount is 25 million. 0.4 means 0.004. And how many months stone will deposit? 4 months. Let us use the calculator. 25 million to this 4 by 12. Students, I'm getting 33,333. I believe everyone is getting the same results. I think examiner could have made a more interesting question by putting one more thing. One, settlement amount under FRA plus examiner should have, I think examiner should have asked one more thing. Will stone company will be receiving that amount or paying? Logically, we will be receiving under FRA 33,333. But examiner did not ask this. Examiner has asked only settlement amount under FRA. So which is 33,333. Okay. Select the type of financial market appropriate to each of the following needs. MB company needs to convert foreign currency into domestic currency. Can I say foreign exchange market where you can convert foreign currency to domestic currency? Okay. Dell company needs, I think it's Dell company needs to issue new long-term loans. A student in money market actually deals with short-term financial instruments. Capital market deals with long-term financial instrument. So Dell company, the relevant market is capital market. Repeat, wherever the term money market comes, you should be thinking for the short-term financial instruments. When we say capital market, then you should be thinking for long-term financial instrument. So basically, Dell company needs to issue new long-term loans, so they will go for the relevant market for them is capital market. Benji needs to issue new ordinary shares. Basically, and there are two markets, primary capital market and secondary capital market. Basically, primary market is the market where new securities are issued by the company. Primary capital market is the market where new securities are issued by the basically company. Secondary capital market means where investors, they are dealing with each other. And what question says, Beijing company needs to issue new ordinary shares. Primary capital market. Carlo company needs to purchase short-term over-the-counter derivatives. Short-term over-the-counter derivatives. Short-term. We have got secondary market and we have got primary money market. I think we did discuss right now that money market. Actually, primary money market is a market which actually deals with short-term financial instrument. And Carlo needs to purchase. If I'm going to purchase, there will be something, this will be the new instrument for me. And I'm going to technically purchase short-term OTC derivative. OTC means which are over-the-counter derivative, means which are available from banks. So simply Carlo needs to purchase short-term over-the-counter derivatives. For you, the relevant market is primary money market. I consider this one as a good question. Let's go to another question. What is the cost of equity for Buckland Marsh Company to the nearest percentage? Cost of equity means they're asking you to calculate what? K. Buckland Marsh Company has current market capitalization 58 million. Current market capitalization actually means V. Simply market value equity. So examiner has given you the total market value equity and has recently paid dividend 5 million, which is the total dividend. Dividend payout ratio is 70%. Stop. If the company is paying 70% as dividend, it means the retention ratio is 30%. Repeat. If the company is paying 70% as dividend, it means the retention ratio is 30%. Return on equity is 20%. So first of all, we need KE. D naught 1 plus G divided by P naught plus G. First, by looking at the data, student, you should be thinking about Gordon growth model to calculate G. The formula is G is equal to B RE. B is the retention ratio. If we are paying 70%, it means we are retaining 30%. RE is return on equity, which they have given us 20%. Logically, the growth rate is 6%. D naught is current dividend per share. P naught is current share price. Since examiner has not given us the total number of shares, there is no problem at all. We can replace D naught with total dividend. P naught will be replaced with V, because right now we'll be using total dividend then divided by total market value equity. So K is equal to, we have got total dividend is 5 million into 1.06. Total market value equity is 58 into 0.06. When in the numerator you are having a total dividend, then in the denominator you need to have a total market value equity. Let's see, 5 multiplied by 1.06 divided by 58 plus 0.06. Students, I am getting 15.137%. So we'll go to the nearest, make it 15. So logically, K is 15%. Okay. The finance director of Tracor company is analyzing the yield curve in the euro market. Normal yield curve is upward sloping. The finance director of, basically by studying the yield curve, you can see the movement of the interest rate. The finance director of Tracor company is analyzing the yield curve in the euro market to select a suitable financing strategy. How to raise the finance? He observed that yield curve has recently changed from normal yield curve to inverted yield curve. Basically, the normal yield curve is like this, upward sloping. Inverted means downward sloping. That with the passage of time, you can also make inverted yield curve like this. With the passage of time, interest rate will fall. That is inverted yield curve. Inverted yield curve means the longer the maturity of the debt, lower will be the interest rate. That is the meaning of inverted yield curve, means inverse yield curve. Under normal yield curve, what happens? The longer the maturity of the bond is, higher will be the interest rate under normal yield curve. But right now, yield curve is not normal, it is inverted, this one. That with the passage of time, maturity increases, your interest rate will fall. Let's see. Which two of the following are true in this situation? One more thing. If with the passage of inverted means the longer the maturity of the bond, interest rate will actually fall. Let's see. Bond with a long-term maturity will have a lower returns, which makes sense. True. Tracor is expected to rising interest rate. Why rising? Yield curve says inverted means interest rate will fall, not rise. The change would have been beneficial for Tracor if it had issued long-term fixed rate debt before what? Inversion. False. Why? Can I say if you have issued fixed rate debt, fixed rate, then either the interest rate increases, decreases, it will have no impact on you. You won't be able to get any benefit. Even the interest rate reduces, you will have to still pay the fixed rate. Raising euro bonds, financing the euro currency has become more attractive. Yes. Simply, organization, they will be interested to take loan. Why? Because interest rate is going to decrease. And it's logically, they should be getting a loan in floating rate. Okay, students. Question number 7. Which of the following is an illustration of principal agent problem? Principal agent problem means principal is doing something which is beneficial for the principal, not for the agent. Okay, let's see. Supplier cutting their cost by using cheaper material to keep their price. It has nothing to do with the agent, principal agent problem. Directors avoiding debt finance because lower interest payments increase their job security. That is a principal agent problem. The question is why this one is a principal agent problem. First, you need to understand one thing. Directors, actually, directors are supposed to work. Directors, they are supposed to work for the benefit of the shareholders, because ultimately beneficiaries, they are the shareholders. But in principal agent problem, directors, the way they make decisions, they are beneficial for them, but they are not beneficial for the shareholders. The question is, directors avoiding debt financing because lower interest payment increases their job security. How come it creates principal agent problem? Basically, shareholders, they are the principal and directors, they are the agents. Okay, now try to understand one thing. If loan is available at a lower interest rate, it will actually reduce cost of capital, number one. If it reduces cost of capital, then it will increase NPV. If it will increase NPV, then company will have to provide a higher return to the shareholder. Obviously, shareholder, they are going to demand a higher return. So directors, they're not interested in this at all. So logic, they just avoid debt financing because of lower interest payments increases their what? Job security. Should a group disagree over dividend policy? That is not a principal agent problem. The stock market exerting pressure? No, no, no. Second one is the principal agent problem. Question number 8. Under which investment appraisal method or methods using company's target will the project be accepted? A project has average estimated cash flows 3,000 per year. Initial investment is 9,000 with zero residual value. Depreciation is straight line and the project is a 6-year lifespan. The company has target return on capital employed 28% and target payback 2.5 years. ROCE is based on average investment. Under which investment appraisal method or methods using company's target will the project be accepted? Obviously, it's a simple payback period, number one. And we have got initial investment divided by simply annuity cash flow. Annuity cash flow. We can directly calculate the time period. So 9,000, we have got annual cash flows 3,000. So we are getting 3 years. So under payback, this project cannot be accepted. Why? The target of the payback is 2.5 years and this project is having a payback of 3 years. So as far as payback target is concerned, it's not met. Let's go for rows. Now examiner has given us cash flow, but in ROC, we need profit. So basically your accounting profit is equal to cash flow minus depreciation. Okay, we can do one thing. We have got 3,000 per year. Keep watching. I can calculate. I need average annual accounting profit. Cash flow per year is 3,000. Multiply by 6. It will give us the total cash flows over 6 years. Minus the total depreciation over 6 years will be 9,000. So the total profit over 6 years will be 9,000 divided by 6. That will give us average profit 1,500. Average annual profit is 1,500. We need average investment. Average investment means initial investment plus RV divided by 2. So logically 9,000 residual value is 0 divided by 2. I'll get 4,500. So very easily we can calculate rows. 1,500 divided by 4,500 into 100, that gives me 33.33%. If you look at ROC, the target is met. ROC target is 28% and this project is actually giving me 33.33%. So only on the basis of ROCE, this project should be accepted. Okay. Let's go for question number 9. Guide Me is a charity that was set up with the objective of what? Training dogs for the blind. Guide Me is a charity that was set up with the objective of training dogs for the blind. Okay. Actually, in case of charity, not-for-profit organization, we measure their performance by using 3 E's: economy, efficiency, and effectiveness. Which one of the following performance measure would best fit effectiveness in value for money? Value for money audit. Effectiveness. Effectiveness means desired results should be achieved. And what is company doing? Training dogs for the blind. Let's see. Average hours to train a dog to Guide Me certification standards. Average hours. Okay. Number of dogs awarded with the Guide Me certification standard. Now this is effectiveness means desired results should be achieved. So the desired results is number of dogs awarded Guide Me certification standards. How many number of dogs they were awarded Guide Me certification standard? Average expenditure you are thinking about, I would say economy. Average hours worked by each dog trainer, you're just thinking about input output. The main thing is effectiveness is point number 2. Number of dogs awarded with the Guide Me certification standards. Question number 10. Which of the following statement is correct? ELA company has decided to invest in a new machine, okay, which has a 7-year lifespan. Lifespan is 7 years. Has no expected RV, zero RV. The machine can be purchased outright for 80,000 using 8% loan. Right now, today, you can buy this machine for $80,000. Alternatively, if I can buy the machine right now for $80,000, so entire 80 becomes your NPV. Alternatively, it can be leased for 7 years by paying an annual rental payment of 14,983 which must be paid at the end of each year. Simply it's a lease or buy decision, but I would say a very simplified. All you need is technically examiner has directly given us NPV of the buy decision, which is 80,000, definitely negative. Now we have to just calculate NPV of the lease decision, whichever is lower, that will be that we are going to accept. NPV of lease decision. Annual rental is 14,983. We will multiply this with annuity factor. How many years? 7. 1 to 7. Just a minute. At 8%. Basically, the interest rate remains same for the bank loan and for lease. Obviously, examiner has not given us more information like tax rate, nothing is given. It's a very simple question. You just need to calculate NPV of lease. If it comes higher than buy, go for buy. If it comes lower than the buy decision, then go for lease. Buy decision NPV is technically given us, which is 80,000. Let's calculate annuity factor for 7 years at 8%. Annuity factor table will be given to you in exam, students. Just a quick reminder if you don't know. 1 minus 1.08, the power is going to be minus 7. This will give you the annuity factor. Let me use a calculator. 1 minus 1.08, power is going to be minus 7 divided by 0.08. I'm actually getting 5.206 multiplied by 14,983. 5.206 into 14,983. I'm getting 78,000. Make it 2. Obviously, 78,002 is lower than 80, so I'll go for lease. Let's see what are the options. The machine should be purchased because this option has lower. No, it's not. Mora company should not agree to either from financing because both the no. When we make financing decision, so obviously you will always have a negative NPV of buy decision, negative NPV of lease decision, whichever gives us a lower negative NPV, we'll opt that. The machine should be leased because the option has a lower overall cost than purchasing. That is true. Okay. Question 11. Which two of the following statement concerning the impact of government decision is true? Allied company is planning a major investment in a new manufacturing unit until the next year. Due to recent concern that inflation is too high, the government has unexpectedly announced an increase in interest rate. So inflation is too high, government has increased the interest rate. Which two of the following statement concerning impact of government decision is true? The company's cost of no, false. Actually, when interest rate will increase, then cost of capital will increase. It will not reduce. This is an example of expansionary monetary policy false. If you increase the interest rate, companies, they will not take loan. Demand for the company's product may decrease. That makes sense. There's a possibility that your product is so expensive, in order to buy your product, people need financing. If interest rate increases, people will not take the loan to buy your product. The NPV of the investment will be lower than yes, because increase in interest rate will increase your WACC. When WACC increases, then obviously your NPV will reduce. Okay, let's go for the next question. Okay, first let me explain something before we go there. I'm just assuming the data, assuming we have got how to calculate theoretical exercise price shares, values, and total value. I'm just assuming that it's right issue, the ratio is company has issued one right against two shares. Assuming the share price, I'm just again assuming the share price before right is 12, it becomes 24. Just a minute, just a minute. Assuming right issue price is 9, so 24 plus 9, I'll get 33. So we can say that 3 shares, they will have total value 33. How to calculate value of one share? TRP. Theoretical ex-right price means share price after the right issue. That will be 11. Theoretical ex-right price means share price after the right issue, it will be 11. Okay, now if I calculate value for right per new share, or you can say gain per right, value of a right per new share, another name is gain per right. Shareholder will be buying right for $9 and they'll be selling it for 11. So on one right, they can generate the benefit of two. Repeat, shareholders, they will be buying right shares at $9, they will be selling it for 11. So basically on one right, they will be getting a gain of $2. Now, in order to have the gain of $2, they need to have how many shares? 2 shares. I need to find out the value for right per existing share. This 2 is a value for right per new shares. So how to calculate value of a right per existing share? First, take the benefit per right, which is 2, divided by the existing share. Interestingly, they are also 2, so I'm getting 1. This 1 is a value for right per existing share. So what is the benefit to me dealing with this data? The benefit is, now, if you know this entire calculation, if you have a really good understanding of this calculation which I've just performed, then you can play with the figures. How? Let's say your examiner is asking you, give me theoretical X right price. Look at this. How can I calculate TRP? TRP is equal to current share price minus the value of a right per existing share. I'll get 11, which is exactly the same. How did I get this 11? If I know the current share price, all I need is minus value of a right per existing share. That will directly give you theoretical X right price. Okay. How did we calculate this gain? Theoretical X right price minus right issue will give us value for right per new share. Look at this. Value of a right per new share. It is actually equal to theoretical X right price minus right issue price. Like 11 minus 9, it has given us the value 2. Okay, now if I have value of a right per existing share and I just need to find out the value of a right per new share. So just do one thing. Take the value of a right per existing share, which is 1, multiply this with the existing shares. You will get directly this 2. So if you know how to calculate theoretical X right price, then you should be able to deal with the data. You should be able to play with the figures. Now let's see. WaveNet company is planning a 1 for 4 right issue. The value of rights has been calculated 0.4 per existing share. 0.4 per existing share. Wavenet company's market price is currently 8 per share. What is the theoretical? Now stop. Theoretical X right price will be 8 minus 0.5. I'll get 7.5. Logically, your theoretical X right price will be 7.5. Now they're asking per share and the right issue price. How to calculate right issue price is very simple. Come here. If you know value of a right per new share, it is equal to theoretical X right price minus right issue price. Now come here. 0.5 per existing shares. In order to get one right, how many shares you need to have? 4. So 0.4 multiplied by 4 will give us value for right per new share is $2. Value for right per new share is $2 is equal to theoretical X right price minus right issue price. Theoretical X right price is 7.5 minus X. So it will be 7.5 minus 2. So logically your right issue price is 5.5. Your right issue price is 5.5. As I mentioned earlier, that if you know the data, if you should be able to deal with the values in the reverse order also. Let's see the question. What will be the ordinary share price be at the end of today? At the end of? If the capital market number one is semi-strong firm efficient. Semi-strong means your share price actually represents past of organization plus the information which has made public. Strong firm efficiency means your share price represents past of your organization plus information which you have made public plus insider information. In case of semi-strong efficient market, if you're going to make investment in a positive NPV project, you need to announce that. Only after making announcement, the impact will come in the share price. But in case of a strong firm efficiency, either you are announcing or not, impact will automatically come. Let's see. Tell the company is a listed company which has 400 million ordinary shares in issue. Total number of shares they have issued 400 million. Yesterday, not today, yesterday the ordinary share price closed $5 yesterday. 2 days earlier, the BOD approved the launch of 2 new innovative products, but this has not been publicly announced. The BOD approved the launch of 2 new innovative products, but this has not been publicly announced. Product A has NPV of 40 million. The decision to launch product A will be announced publicly when? Tomorrow. Okay. Product B has NPV of 160 million. The decision to launch product B will be announced publicly in this morning. So when early in the morning you will be announcing the product B NPV will be 160 million, then its impact of this will come in your share price today because you are deciding early in the morning. But 40 million impact will not come in your share price in case of semi-strong, because in case of semi-strong form, share price will only have the impact when you announce. So logically 160 million divided by 400. Let me use the calculator. Let's see the share price. Logically, your share price will increase by 0.4. Yesterday it was 4. Early in the morning, today, early in the morning, if your company announces about the project B, which will give you 160 million NPV, so logically, Due to this announcement, in case of semi-strong form efficient market, your share price will become 5.4. In case of semi-strong efficiency, 40 million impact will not come today to your share price because you are not announcing it. Now, so under semi-strong efficient market, your share price will be 5.4. Strong form efficient. Now listen, strong form efficient means your share price actually reflects information of past, public plus insider information. Then either you are announcing, you are not announcing, no issue at all. Share price will have the impact. So it means, assuming all other things are equal, and that capital market believe the project NPV, both products will be financed using internally generated funds. Now look at this option one, semi-strong. That's wrong. Obviously, if 5 is wrong, then other one is also wrong. 5.1 is not possible. Only possibility is 5.4. Here the share price will not change, it will remain 5. The question is why it will remain 5. Now listen carefully. If it is a strong form efficiency, then your share price will already have the impact of product A and B. No need of announcement. So logically the option 3, why option 3? Let me repeat. In case of a strong form efficiency, this announcement will not make any difference because share price shows past information which has been made public plus insider information. Okay. Which of the following statement concerning traditional theory? If you recall traditional theory of capital structure, then under traditional theory, actually we try to maintain a balance between debt and equity, which we called it optimal capital structure, where we have a lower WACC. There's an optimal capital structure for the company where market value is maximized. Yes. Optimal capital structure means where WACC will be lower. When WACC will be lower, obviously your market value of the business company will increase. Buying and selling shares by arbitrage ensures share prices are not at all. Cost of equity of the company decreases as its capital gearing. Which of the following statements concerning the traditional theory of capital market is correct? So basically, the cost of debt of the company is constant. So logically, number one, when you talk about traditional theory, so basically traditional theory of capital structure says there is an optimal capital structure where market value is maximized. Which two of the following statements concerning interest rate risk management method of smoothing are true? Okay. The debt portfolio will consist of mixture of fixed and floating rate. That is true. But basically in smoothing, I'll be keeping a portfolio of debt with a mix of few debts. They will be in fixed rate, few debts they will be in the floating rate. That is smoothing. So that due to change in interest rate, more or less it should not affect me. How? If interest rate falls, then obviously the loan portfolio of loan which is at variable rate, I'll be paying less interest on that rate, on that loan, but still I'll be paying a fixed portion as well. So on one portion of the loan, I'll be having a benefit if there's a fall in the interest rate, but other portion of the loan, technically, I'll be paying a fixed interest, means I'll be having a disadvantage. So smoothing means I'll be keeping both debts. Some of the loan they will be in fixed rate, some of the loan they will be in variable rate. Interest payment will still increase if the interest rate rises. That is true. Why? Let's say some of your loan they are in fixed rate. So obviously rise in the interest rate will not affect your fixed rate debt, but rise in the interest rate will impact your variable rate loan. So even you are holding a portfolio of mixture of fixed and floating rate, but still when the interest rate rises, logically your interest payment will rise. Okay, investment with fixed cash flow will be financed for fixed. Actually, when investment with fixed cash flow will be financed with a fixed rate of debt, that is matching. It is not smoothing. Smoothing means I'm holding fixed and floating both type of debt. Full benefit will be obtained from a fall in interest rate. I won't be able to get the full benefit. Why? I won't be able to get the full benefit. Can I say even the interest rate falls? I'll be having two types of loan. One is in fixed rate, another is in floating rate. I will get the benefit, but only on the loan which is in floating rate. I'll be also having a loan in fixed rate, so still I have to pay the same. So I won't be able to get the full benefit due to fall in interest rate. Net effect will be the interest payment which is fixed. Overall, there is no such thing. So A and B. So student, you can see that examiner has almost tried to cover each and every area of FM in first 15 questions. Okay. Let's go ahead. The following scenario relates to questions 16 to 20. Let me drink water. And the question is regarding bulk purchase discount of from Tandy company. Okay. Students, read the requirement. What is the financial consequence of accepting the bulk purchase discount from Tandy company? Let's see. All you need is first you need to calculate your existing annual inventory cost, and then we will compare that with the revised annual inventory cost with bulk purchase discount. If the revised annual inventory cost is lower than the existing annual inventory cost, then there will be benefit. Otherwise, there will be a net cost. The following scenario relates to question number 16 to 20. Doonday Company is a large company which has been reviewing its working capital management. D company has received an offer of discount for bulk purchase from 10D company. One of its major supplier, 10D company, has offered 0.75% discount. But order has to be 30,000 units or more of component X. The current purchase price of component X is $20. D company currently consumes 1,20,000 units of component X. So the annual demand is 1,20,000 each year. And they places order of 10,000. So currently they are placing their order size is 10,000 at the end of each month. Holding cost is 1.2 per unit per year. Ordering cost is 120. So, okay, student, let us first calculate existing annual inventory cost. Existing annual inventory cost. First, we will be calculating ordering cost. Annual demand is 1,20,000 and current order size is 10. So logically, the number of orders will be 12. Per order cost is 125. Let me use the calculator. 12 into 125, I'm getting 1,500. Holding cost, we assume that 50% of the order size is in your warehouse. Multiply by per unit holding cost, which is 1.2. I'm getting 6,000. At least we can say one thing. Their current order size is not EOQ. Why it is not EOQ? Because if 10,000 was an EOQ, then ordering and holding cost should have been equal. They are not equal. It means currently you are not following EOQ. Okay. Purchases cost. 1,20,000 is the annual demand per unit they purchase from the supplier by paying $20. I'm getting 2.4 million. So here comes your annual inventory cost 240750. Now we have to compare this with the bulk purchase discount. Bulk purchase discount. Let's see. Ordering cost. Students, annual demand is 1,20,000. In order to get the bulk purchase discount, your order size has to be 30,000. Your order size has to be 30,000. Per order cost is 120. So logically, number of orders will be 4. Ordering cost, I'm getting 500. Again, we know that there's an assumption that 50% of the order size will be in warehouse. Holding cost. $30,000 divided by 2 into 1.2. I'm getting 18,000. Purchases cost. Annual demand is 1,20,000. Earlier we were getting one unit for $20. Discount is 0.7. Now listen, 100 minus 0.75. I'll get 99.25. So multiply this with 0.9925. 9925. Let's see what I'm getting. 1,20,000 multiplied by 20 into 0.9925. That gives me 2.382 million, I believe. 2382000. So student, you can see that revised annual inventory cost is lower than existing annual inventory cost. Logically, there's a benefit of 7,000. The benefit is 7,000. There's an annual benefit of 7,000 because your revised annual inventory cost is lower than your existing annual inventory cost. So your company will have a benefit of 7,000 annually. So the benefit is 7,000. Great. Let's move to the next part. What is the financial consequence of accepting early settlement discount from Salvo company? Early settlement discount. Student, you are receiving. Now listen, first understanding. Basically, if I receive early settlement discount, so of course, receiving early settlement discount is income for us. But don't forget one thing. You will only get the early settlement discount obviously when you are paying early. When I'm paying earlier than what I was paying before, when I'll be paying earlier than the days which I was taking before that, what happens due to early payment? There will be reduction in trade payables. And due to reduction in trade payables, finance cost will increase. So you have to just compare two things. The amount of the discount which you are getting due to early settlement, and the second is increase in the finance cost due to reduction in trade payable. Either there will be net benefit or there will be net cost. Let's see. And Salvo company. Salvo company, a major supplier of component M. Student, first we were dealing with component X. Now it's a different component. And this component is component M to D company. Has offered a 1% early settlement discount for payment within 20 days. D company currently takes 60 days to settle outstanding invoices. So it means logically you will be paying 40 days earlier. And this equates 3.3 million as trade payable. So when company makes payment in 60 days, your trade payable is 3.3 million. Obviously, when you will be paying in 20 days, then your trade payable will reduce. Reduction in trade payables will increase your finance cost. Okay. Just D company has a cost of short-term finances 5%. And assuming how many days are there? 360. Fine. Now, please, you need to understand first. We are dealing with component M. Just a minute. We're not dealing with component X now. We are dealing with component M. Let me calculate total purchases. Trade payable is 3.3 million. Student, now listen carefully. 3.3 million means I am making payment in 60 days. This 3.3 million is my trade payable, which shows that I'm making payment in 60 days, which means that my annual purchase will be, we work 360 days in a year. 3.3 million represents that I make payment in 60 days. So here comes your annual purchases. 3.3, 360 upon this, 19.8 million. Obviously, if you take 19.8 multiplied by 60 upon 360, it will give you 3.3. Why did I calculate 19.8 annual purchases? Because I need the amount of purchases. On that purchases amount, I will apply the discount, which is 1%. So discount receive is income for me. Discount receive 19.8 is 19.8 million. 1% means 0.01. Student, the amount of the discount is 0.198 million. But obviously, you are getting a discount, you are receiving a discount, which is income for you. But it is only available when you make payment 40 days earlier. If I'll be making payment 40 days earlier, then trade payables will reduce. When trade payable will reduce, my finance cost will increase. So less increase in finance cost. Increase in finance cost. Annual purchase, they are 19.8 million. 40 upon 360 actually shows reduction in trade payable. Why? Before the discount, we were taking 60 days to pay. In order to get discount, we'll be paying in 20 days. How many days earlier we'll be paying? 40 days. So I'm calculating reduction in trade payable. 19.8 multiplied by 40 upon 360 will give me reduction in trade payable, fall in trade payable. When there's a reduction in the trade payable, then your finance cost will increase. Short-term financing rate is 5%. 19.8 million multiplied by 40 upon 360. Students, I am getting 0.11 million. So there's a benefit. 198 minus 0.11. Student, I'm getting a benefit of 0.088 million. That's your annual benefit. Let's see the option. Okay, they have given us values in 1000, no issue at all. You just multiply this with 1 million. You will get the result. I'm getting 88,000. So the annual benefit is 88,000. Your annual benefit is 88,000. Which of the following is the annual percentage cost? Annual percentage cost of the discount given to Carlos and receiving 15,000 within 30 days. Which of the following is the annual percentage cost? Okay, we are providing the discount. Of course, when you provide the discount, it is cost for you. But they're asking, give us the percentage of the annual cost. Let's see how much discount we are providing. D company is due to sell goods to Carlos, costing $15,000. The terms of the trade state that payment must be received in 120 days. Okay. However, a discount of 2% will be given for payment in 30 days. That's something very important. We are selling goods to our customer. Normally, customer, they make payment in 120 days, but we are ready to give them a discount of 2%, provided that instead of 120 days, they should be paying us in 30 days. And we are here to calculate annual percentage cost. Now, student, how much discount we are giving? 2%. Now, try to understand. Assuming my selling price is 100, I'm giving a discount of 2%. So, after discount, I'll be getting 98. I'm just assuming my selling price is 100. I'm giving a discount of 2%. So, after discount, I'll be getting 98. Fine. I need to calculate annual cost percentage of discount is equal to 1 plus. I'll be getting 98 by giving a discount of 2. I'll be getting 98 by giving a discount of $2. Okay. But what happens then? I'm going to get discount. Try to understand. Normally, my customer makes payment in 120 days. No discount. Now the customer, instead of 120 days, will be making this payment in 30 days. How many days earlier customer will be paying me? 90 days earlier. I will give discount of 2%. But logically, my customer will be paying me how many days earlier? 90 days earlier. Okay. Now, how many times this event will happen in the entire year? In the entire year, total days are 360. 360 divided by 90, I'll get 4. So in the entire year, this will happen 4 times. So power is going to be 4. Repeat, how did I get power 4? Without discount, I give 120 days to my debtors, customers. If they need discount, they will be paying in 30 days. How many days earlier they will be paying? 90 days. 360 divided by 90. So this event will be repeated 4 times. Minus 1. Let us use the calculator. 2 divided by 98 plus 1, whatever comes, take the power 4, minus 1. Students, I'm getting answer 0.0841, then multiply by 100, I'm getting 8.416%. So I'll obviously 2 decimal, then I'll go for 8.41%. Okay. Which of the following is correct? Let's see. Factoring with recourse. Basically, with recourse means factor company is responsible for the bad debts. Technically, you have insured your bad debt. So, with recourse means factor is not, my bad. With recourse means factor is not responsible for the bad debts. With recourse means your company will face the risk of bad debt. Factoring with recourse means that you do not have bad debt insurance with the factor. That is true. Actually, in case of non-recourse factoring, your bad debts will be insured. In case of non-recourse factoring, your bad debts will be insured. But in case of with recourse factoring, your bad debts are not insured. With recourse factoring means your factor is not responsible for the bad debt. So number one is true. Invoice discounting can increase the efficiency of trade receivable management for a company. False. Invoice discounting means you're just getting the payment earlier. Invoice discounting does not involve that they will be going and collecting the cash from your receivable. So invoice discounting will increase your liquidity, but it will not help in trade receivable management. Companies expecting to receive foreign currency from foreign accounts receivable will be concerned about the risk of foreign currency depreciating. Yes, actually, if there is a receivable in the foreign currency, then obviously we face the risk that foreign currency could depreciate. When the foreign currency depreciates, then I will convert that foreign currency into my local currency. I'll be getting a less amount. So basically 1 and 3. Which of the following directly leads to a conflict between working capital objectives of liquidity and profitability? Using economic order quantity model to determine, no, it has nothing to do with it. Offering early settlement discount. If you're offering early settlement discount, then your liquidity will improve. But there is a possibility that profitability may reduce. To customer encourage prompt payment of for debts, limiting the level of cash balances held to those required to meet normal business needs. It's not liquidity and profitability. So mainly, if you're offering early settlement discount, it will actually increase your liquidity, but there's a possibility that your profitability might reduce. So I hope till here everything should be clear to you. Let's see. What is the value of Gonzola company using P ratio method? P ratio. Okay. We need to calculate value of the business by using P ratio. Gonzola company, a listed company with a cost of equity is 12%, which plans to achieve dividend growth rate 5% per year for the foreseeable future. Gonzola company operates in an industry with average P ratio 12.5 times. So I can easily use this average P ratio 12.5 times. The ordinary share price of the company have nominal value 0.5 per share. That's a par value. Extract from the financial statement. Profit for the year, student, very easily I can calculate business value. Profit after tax into P ratio. Gonzalo operates in an industry with an average P ratio. Examiner has given us. Gonzalo operates in an industry with an average P ratio. Examiner has directly given us the average P ratio 12.5 times of the company, because look at this. Gonzalo operates in an industry and it has an average P ratio 12.5 times. Great. So things are very pretty easy. 264 Gonzala's average P ratio, examiner has given me 12.5 times. So 12.5 times is the P ratio of Gonzala, which examiner has given us. So we should be thankful to the examiner. I'm getting 3,300 million. Okay. What is the value of one share in Gonzala using dividend valuation model P naught? How do we calculate P naught by using DVM? P naught is equal to D naught 1 plus GKE minus G. That will give you P naught. Let's see. Cost of equity. Student, examiner has given you 12%. Growth rate, examiner has given you 5%. Great. Par value is 0.5. Ordinary share capital is 100 million. Total number of shares. Share capital divided by par value. So the number of shares are 200 million. Ordinary dividend is 160. That is your total dividend. Total dividend divided by total number of shares will give us D naught, dividend per share. Total dividend is 160 million and total issued shares of the company, they are 200 million. So simply 160 divided by 200, I'm getting 0.8. So student, now you should be able to calculate P naught. 0.8 growth rate they have given us 5%. K is 12, growth rate is 5. So in the denominator, I'll get 0.07. 0.8 into 1.05 divided by 0.07. Students, I'm getting 12. Current share price I'm getting, that is 12. What is the market value of loan notes to Gonzilla Company? Market value of loan note. Let's see. The long-term borrowing consists of loan notes paying interest 7% per year, which are redeemable in 7 years' time at 5% per annum to their nominal value 100 per loan note. The before tax cost of debt Gonzilla is 5%. For calculating market value debt, we need cost of debt before tax. Actually, market value of debt is equal to present value of future cash flows. Logically, maturity period is 7 years, so cash interest will be 7 every year. And the maturity period is 7 years, so 7 multiplied by annuity factor from 1 to 7. Plus, in the last year, company will be paying 105 also. 100 is the principal plus 5 is the premium. We will multiply this with the discount factor of 7 year. Discount factor of year number 7. Annuity factor 1 to 7 at 5%. Annuity table will be given to you in exam, students. 1 minus 1.05 minus 7. This will give us the annuity factor of 7 years. 1 minus 1.05, the power is minus 7 divided by 0.05. I'm getting 5.786. 105 into 1.05 minus 7. Let's see. 7 multiplied by 5.786 plus 105 multiplied by 1.05 power minus 7. Student, I'm getting a market value 115.12. This is the market value of one debenture. An examiner asks, what is the market value of loan notes? Okay. If you look at this, long-term borrowing is 300 million. Par value is 100. We'll take the long-term borrowing from the SOFP, which is 300, multiply by 115.12 divided by 100. That will give you the market value of entire loan note. 300 into 115.12 divided by 100. I'm getting 345.36 million. If you are not getting the exact answer, go for the closest one. So can I say the last one? The closest one is 345.5. Okay. Which of the following statement about noise trader are correct? They generally underreact to good news and bad news false. They make rational decisions. No, actually they make uninformed decisions. Both are incorrect. This is they have taken from behavioral finance. There's a little topic in your syllabus, behavioral finance, they have taken from there. Wow. Which of the following statement are correct? Are correct. Equity finance reserves represent cash which is available to a company to invest. You can say there's a possibility cash is available, but there is a slight possibility cash might not be available. Equity finance reserves represents cash which is available to a company to invest. Basically, you can say there's a possibility cash is available, but there's a still possibility. that cash might not be available. It is possible that you have already spent the cash. Your reserves have increased due to profit, but there's a possibility cash is not available. So this is not correct. False. EPS is an unsuitable way of assessing financial performance against Gonzalo company's competitor. That is true. Why? How do we calculate EPS? Simply profit after tax divided by total number of shares. Obviously, each company will not have the same number of ordinary shares issued. Different organization will have different number of ordinary shares issued. So rather than EPS, you can go for P ratio. You can compare the performance on the basis of P ratio rather than EPS. Scrip dividend decreases the liquidity. No. Actually, scrip dividend will increase the liquidity. Why? Due to scrip dividend, number of shares will increase. When the number of shares will increase, share price reduces. When the share price reduces, liquidity increase. Liquidity means buying or selling of the shares will increase. So this is also false. Only one is true. Second one. A student, let's see what question is asking. Which of the following currency risk is Bismuth company exposed to now and in the future? Now and in the future, let's read the scenario. Which of the following currency risk? Okay. Ooh, no. Bismuth company whose home currency is the dollar has exported products to Europe for several years. And all European customers pay on credit in euros. It now plans to invest in European storage, packing, and distribution network. Means you will be buying non-current asset over there. When you are buying non-current asset in a foreign country, then you will be facing translation risk. Why? Because you will be buying them in euro and obviously then you will be converting them into your home currency. So you have to bear the translation risk. The finance will be provided by an immediate 6.5 million euro loan, note issue, with an annual interest payable in 2 installment in euros on 6 months annually. Okay, now when you will be paying interest, obviously when you have taken a loan in euros, you will be paying interest in euros. When you will be paying interest in euros, you will have to bear transaction risk, which is a short-term risk. The first payment will be $260,000. So obviously you have to bear transaction risk, you have to bear the translation risk. And one more thing, to finance will be provided by an immediate 6.5 million loan note issue. Now listen, you are going to make investment in a European country, you will be buying the non-current asset for storage, packing, and distribution network. You will be buying them in dollars, so obviously you will be facing translation risk. Another thing is, of course, you have taken a loan for a longer period of time. So you're not paying just interest only in 1 year, you will be paying the interest in euros over a longer period of time. It means you will be facing then the trend of dollar and euro over the longer period of time will disturb you. So logically, you are facing transaction risk, translation, as well as economic risk as well. So all of them. Transaction risk is a short-term risk, but translation, economic, both are the long-term risk. Okay. According to the exchange rate theory, which of the following could explain current euro $1 forward exchange rate to this? Let's come in. The first payment will be due spot exchange rate. Student, look at this spot rate first. Spot rate is $1. Logically, it is equal to euro 1.30 and 1.34. Of course, one is a buying rate, another is a selling rate. Technically, When we say $1, so $1 comes in the denominator, euro comes in the numerator. It's an indirect quote. Indirect quote, we buy low, we sell high. Okay. But I just want to tell you one thing. You can see one thing. Right now in $1, you can get, in case of buying, the rate is 1.30 for you. In case of selling, the rate is 1.3 for you. 3.4 for you. Okay. Now let's read what is happening here. According to the exchange rate theory, which of the following could explain the euro? It's the exchange rate theory. Which of the following could explain current euro $1 forward exchange rate? Look at this. 6 months forward rate is this. Try to understand the 6 months forward rate. In 6 months time as compared to spot, in 6 months time as compared to spot, we can say one thing. Euro is getting stronger. Why euro is getting stronger? Just take it very simple. Earlier in $1, let's say you were able to get 1.3 euros. But in 6 months time, you will be able to get, in $1, you will be getting 1.28. So as compared to spot, euro is getting stronger. As compared to spot, euro is getting stronger. Just make it simple. At spot, your company was able to get, in $1, you were able to buy 1.3 euros. But in 6 months time, you will be able to buy 1.28 euros. So it means euro is getting stronger. Now let's see what they are saying. The euro inflation rate is higher than the dollar. No. False. Why false? Student, in case of purchasing power parity, the country which has a higher inflation rate will have a weaker currency. Now try to understand. By looking at the forward exchange rate, it looks logically, if that forward exchange rate shows that euro is getting stronger, it is not getting weaker. According to the point number one, euro is getting weaker, but the data says euro is getting stronger. The supply of dollar is expected to decrease in the near future. It has nothing to do with this. The euro interest rate is lower than the dollar. That is true. The euro interest rate is lower than the dollar interest rate. By looking at the forward rate, we can say that over the period of time, in the future, what is happening? In the future, basically, euro interest rate is lower than dollar interest rate. And that is why euro is getting stronger. The government of the euro country has been selling. No. Students, see. And one more. So you should be able to understand that initially at a spot rate, in $1, you were able to get 1.3 euros, but in 6 months time, in $1, you are getting 1.28. It means euro is getting stronger. So interest rate in euro will reduce. Simply purchasing power parity. If Bismuth company decides to make a lead payment, means payment in advance for interest, rather than using a 6 months forward, so they're not using 6 months forward, they're just making the payment right now. What is the cost saving to Bismuth of the payment? Bismuth does not need to borrow to finance the lead payment. So in order to make payment in advance, they are not going to borrow. Okay, let's see. The first payment is 2,60,000. Spot rate is, you can see that it's an indirect quote payment. Indirect quote payment, we buy low. So lead payment means payment in advance. If we pay today rather than paying in 6 months time by using forward rate, 260 divided by 1.3. So it is $200,000. If we go for 6 months forward, instead of lead payment, 6 months forward, 260 divided by 1.28. Let's see what are we getting. Why I'm getting a lower rate? One, it is an indirect quote. Second, we are dealing with the scenario of payment. So I'm getting 2 lakh 3,120 So if you go for 6 months forward, you will end up by paying 2 lakh 3,125. Lead payment means you will be paying just 2 lakh. So you are saving 3,125. This is what examiner was asking. So you are saving 3,125. You are saving 3,125. What should Bismuth company do in dollars now to correctly set up money market hedge on the payment of interest expected in 6 months time? Payment. If you recall money market hedge, payment. Step one is for payment, step one is deposited amount. Euro 2,60,000, we will borrow the present value of 260. Money market rates available to Bismuth 1 year euro. Deposit rate is 2% for the whole year, but we'll be depositing for 6 months. 1%, 1.01. So let's see. We are not going to deposit 260. We'll be depositing the present value of 260. Because 260 is a payment in 6 months time. It's a future payment. So today I'll be depositing the present value of that. So 260 divided by 1.01. I'm getting in euros, I'm getting 2,57,426. Step 2 is borrowed amount in dollars. In order to deposit 2 lakh euros, 2,57,426. How many dollars I need to borrow today from the spot rate? I'll be using 1.30. A student, all you need is you need to have a very good grip on the money market hedge format. 2,57,426 divided by 1.30. I'm getting 1,98,020. So basically today you should be borrowing in dollars 1,98,020. 1,98,020. Okay, then let's see. Which of the following statement about interest rate risk are correct? A negative gap exposure means that for a given maturity date, interest rate sensitivity liabilities are less. No. Less than interest rate. Actually, your liabilities should be more. So false. The bank loan of Bismuth company give rise to the basis risk. Actually, when you are taking a bank loan in fixed rate, so there's no basis risk. You will face basis risk when you are taking loan in floating rate. So both of them are actually false. So students, that is all about, I would say, section A and B, which I wanted to discuss today. When it comes to section C, I'll announce the date for the section C, and I think within just few days, we will be discussing the section C of ACCA pre-scene mock as well. Or there's one more possibility. You can attempt section C, and if you have any queries, you can always ask in your relevant WhatsApp groups. Plus those students, they are enrolled with me, of course, in the entire FM, any topic which you think you need a live revision. So I'm open to conduct live classes for that topic. So do mention in your relevant WhatsApp group if you need a revision on any topic. Plus those students, they are enrolled, they know that in our regular course, there's a regular course, plus there are two different types of crash courses that are already included in your they're already on your portal as well. And plus my WhatsApp support is available. Plus I hope everyone is having FM short notes as well, because FM short notes, they will really help you to get a very good grip on theory. So that is all about today's ACCA pre-scene mock, December 25. From my side, Abil Ahmed from ASA, Abilu School of Accountancy. So thank you very much for watching this lecture. Do give your feedback and any other let's say, help you need on FM, I'm more than available. We'll be conducting pre-scene mock classes for tax, PM, FR, AFM I've already conducted, SBR and ATX, and plus AA classes. So all the pre-scene mock we are going to discuss. So thank you very much. Hope to see you all and others in the coming classes also.